Donald Trump thought he had Canada boxed in. He believed he had engineered the ultimate pressure point, a mechanism that would force Ottawa to bend sooner or later because the cost of resistance would simply be too high. But this week, the market sent a very different signal. The Canadian dollar didn't collapse. U.S. equities wobbled. Trade desks from London to Tokyo began quietly recalibrating their exposure to American volatility. And behind all of that movement, behind the currency stability, the bond spreads, the hedging activity, sits a single clause buried deep inside a trade agreement that Trump himself negotiated and signed. A clause designed to give Washington leverage, a clause that now appears to be squeezing Washington instead. This isn't just another tariff headline. It isn't just steel, aluminum, or auto parts. This is structural. It's legal, it's strategic, and it's unfolding on a clock that cannot be ignored. In July 2026, a mandatory review provision inside the United States-Mexico-Canada agreement triggers a moment of truth. And Canada has made it increasingly clear that it is prepared to let uncertainty hang over North American supply chains if it doesn't get acceptable terms. That changes everything, because when uncertainty becomes mutual instead of one-sided, leverage shifts. And when leverage shifts in a $1.5 trillion trading relationship, markets react fast. The real shock here isn't that there's tension. It's that the mechanism driving this confrontation was built by the very administration now feeling its pressure. The same sunset clause, once celebrated as a masterstroke of negotiating genius, is now functioning exactly as written, only not in the direction Washington expected. So what happened? How did a tool designed to keep Canada nervous end up injecting instability into American manufacturing states? Why are U.S. business leaders suddenly sounding alarmed? And what does this mean for your investments, your retirement accounts, and the economic stability heading into a midterm election cycle? Because make no mistake, this is no longer theoretical. The clock is ticking. The review date is approaching, and the markets have already started placing their bets. Hi, I'm Susan, and I break down the political and economic power plays that shape real-world consequences, not just in headlines, but in your wallet, your job market, and the stability of the global system we all depend on. And today, we need to take a hard look at what's happening between Washington and Ottawa, because beneath the surface rhetoric, there's a sophisticated strategic contest unfolding that most people aren't seeing clearly yet. Over the next several minutes, I'm going to walk you through exactly how this clause works, why it matters far more than the tariff numbers dominating cable news, how Canada's leadership quietly prepared for this confrontation, and why the United States now finds itself squeezed between economic reality and political optics. We'll look at the legal architecture of the agreement, the business community's growing anxiety, the fracture lines emerging inside the Republican coalition, and the global signal this sends to America's allies. But to understand why markets reacted the way they did this week and why investors are suddenly paying attention, we have to go back to the origin of the clause itself and the strategic assumption baked into it from the beginning, because that assumption is where everything begins to unravel. Let's start there. To understand how this moment came together, you have to understand the person sitting in Ottawa right now. Mark Carney did not arrive in office through the traditional partisan trenches. He didn't spend decades climbing committee ladders or sharpening attack lines for cable news. He built his reputation in central banking, first at the Bank of Canada, then at the Bank of England, steering major economies through turbulence that would have broken less disciplined hands. During Brexit, when markets swung wildly and political uncertainty threatened to spiral into financial instability, Carney's approach was methodical, calm, and rooted in a deep understanding of leverage, liquidity, and risk psychology. That background matters now more than ever. When the United States imposed 25% tariffs on Canadian steel and aluminum earlier this year, the expectation in Washington was predictable. Historically, Canadian prime ministers respond to trade shocks by moving quickly to de-escalate. Phone calls are made, emergency meetings are scheduled, diplomatic language smooths over the sharp edges while business groups quietly lobby for restoration of the status quo. That script did not unfold this time. Instead of scrambling, Carney slowed the tempo. Instead of flying immediately to Washington, he began building optionality. Retaliatory measures were filed through formal channels, but they were measured, calibrated, not theatrical. Simultaneously, Canadian trade officials accelerated exploratory conversations with the European Union. Delegations moved through Tokyo and Seoul. Investment discussions intensified around critical minerals, uranium, lithium, rare earth elements, the raw materials that sit at the foundation of electric vehicles, semiconductor production, and advanced defense systems. None of it was loud. None of it was impulsive. It was strategic diversification, the financial equivalent of reinforcing exits before a fire alarm is ever pulled. And while that outward diplomacy unfolded, something quieter was happening inside Canada's trade ministry. Legal teams were directed back into the text of the United States-Mexico-Canada Agreement, the document that replaced NAFTA and was celebrated at its signing as a once-in-a-generation victory. Deep inside that text sits Article 34.7, a provision that at the time was described as a sunset clause. On the surface, it sounds straightforward. In practice, it is anything but. Here's how it works. In July 2026, the three member countries are required to conduct a mandatory joint review of the entire agreement. At that review, all three must affirmatively agree to extend the pact for another 16 years. If all agree, the deal locks in stability well into the next decade. But if even one country declines to extend, the agreement does not immediately collapse. Instead, it enters a period of rolling annual reviews, year after year through 2036, with the possibility of termination hanging over every supply chain decision in North America. When this clause was negotiated, it was framed as leverage for Washington. The logic was simple. Because Canada and Mexico rely heavily on access to the U.S. market, the periodic threat of expiration would keep them aligned with American priorities. The uncertainty itself would function as pressure. Every 6 years, they would face the possibility of disruption and therefore negotiate from a position of caution. It was marketed as a masterstroke, a structural advantage embedded in the architecture of the deal. But leverage is rarely one-directional in integrated economies. The United States and Canada are not loosely connected trading partners. They are deeply interwoven. Auto parts cross the border multiple times before final assembly. Agricultural supply chains depend on predictable regulatory alignment. Energy grids are interconnected. Manufacturing investment decisions are made on 10 and 20-year timelines based on assumptions of stability. Once uncertainty is introduced into that ecosystem, it doesn't just pressure one side, it radiates outward. And this is where the blade turns. If Canada signals that it is willing to allow the agreement to enter rolling annual reviews rather than accept unfavorable conditions, it injects systemic uncertainty directly into American manufacturing states. Investors who once assumed a clean 16-year extension must now price in annual renegotiation risk. Companies considering new plants in Michigan or Ohio must ask whether tariff conditions could shift within 12 months. Pension funds holding equities tied to cross-border supply chains begin recalculating exposure. The brilliance and the danger of Article 34.7 is that it weaponizes uncertainty itself. It doesn't require dramatic action. It doesn't require public confrontation. All it requires is a refusal to provide reassurance. And over the past several weeks, Canadian officials have subtly adjusted their tone. Gone are the hedged reassurances about seamless extension. In their place is calm, measured language emphasizing sovereign decision-making and economic diversification. Markets notice tone shifts long before voters do. When the Canadian dollar holds steady instead of sliding under tariff pressure, that is not random. That is capital interpreting strategic intent. Here's the critical turning point. The Sunset Clause was designed under the assumption that Canada feared instability more than the United States did. But if Ottawa calculates that the cost of accepting new restrictions outweighs the cost of tolerating structured uncertainty, the pressure becomes mutual. And in a mutual pressure scenario, the larger economy does not automatically win. The more interconnected economy often bears heavier collateral effects. This is the first major payoff in understanding what's unfolding. The clause works exactly as written. It just doesn't guarantee the outcome its architects assumed. If you value breakdowns that go beyond headlines and actually unpack the mechanics behind the drama, make sure you're subscribed so you don't miss the next phase of this story. Because the next layer is where this shifts from strategic chess to political squeeze. And that's where things get even more volatile. Now that we understand how the clause operates, we need to examine the deeper miscalculation baked into Washington's approach. The assumption that Canada would never tolerate entering that annual review cycle. That assumption is where the trap truly begins to close. The strategic miscalculation at the center of this confrontation isn't just about trade math, it's about a pattern, a recurring collision between personal leverage politics and institutional reality. And if you zoom out for a moment, this pattern looks familiar. Over the past decade, we've watched versions of it play out again and again. An ally is elevated. Loyalty is assumed, institutional guardrails intervene, and when those guardrails refuse to bend, the response is shock, sometimes outrage, that the system does not yield to pressure. Jeff Sessions was appointed Attorney General after being one of the earliest and most vocal supporters in the Senate. But when the law required him to recuse himself from overseeing an investigation tied to the 2016 campaign, he did so, not because of disloyalty, because of legal obligation. The reaction was fury. Public humiliation followed, eventually removal. William Barr was widely seen as a more reliable institutional partner. Yet when he publicly stated that the Justice Department had not uncovered evidence of widespread election fraud sufficient to alter the 2020 outcome, that too was framed as betrayal. Loyalty, in these moments, ran headlong into statutory limits. Mike Pence faced a similar constitutional boundary on January 6th. However intense the political pressure, the vice president did not possess unilateral authority to reject certified electoral votes. That was not a matter of discretion. It was structural design. The pattern is not subtle. The moment institutional architecture constrains tactical ambition, the architecture is treated as obstruction rather than framework. And now that same dynamic is unfolding in trade policy. The United States-Mexico-Canada agreement is not a press conference. It is not a slogan. It is a legally binding trilateral structure negotiated line by line. It contains review mechanisms, dispute settlement panels, withdrawal provisions, and sunset triggers that operate independently of political mood. Once signed and ratified, it becomes part of the institutional fabric governing cross-border commerce. It cannot simply be overridden by rhetoric. The assumption inside Washington appears to have been that Canada would never risk allowing the agreement to slide into rolling annual reviews. The numbers seem persuasive. Roughly 3/4 of Canadian exports flow to the United States. The auto sector, energy shipments, agriculture, deeply integrated, deeply dependent. From that vantage point, Canada looked economically captive. The logic followed that when the July 2026 review approached, Ottawa would negotiate from fear of disruption. But that assumption rested on a static model of dependency. It presumed that Canada would continue organizing its economic posture around U.S. centrality without adjusting strategy in anticipation of pressure. That presumption turned out to be flawed. Since 2025, Canadian export patterns have been quietly evolving. Trade flows toward the European Union have increased. Pacific Corridor infrastructure has been expanded. Investment discussions around critical minerals have intensified with Asian and European partners eager to secure supply outside of China's orbit. These are not overnight transformations, but they don't need to be. They only need to shift marginal leverage. Consider the minerals at stake. Saskatchewan's uranium supports nuclear energy production abroad. Quebec's lithium feeds battery manufacturing. Rare earth elements from the Northwest Territories are essential to advanced electronics and defense technologies. In a world scrambling to secure resilient supply chains for clean energy and semiconductor production, those assets matter profoundly. They create optionality, Optionality is power. If Canada can signal credible alternatives, not full replacement of U.S. trade, but meaningful diversification, then the psychological balance changes. The cost of uncertainty is no longer one-sided. It becomes a shared exposure. And this is where the calculus becomes brutally simple. From Washington's perspective, tightening rules of origin, imposing digital trade constraints, or conditioning extension on new concessions may appear as incremental negotiating gains. From Ottawa's perspective, accepting terms that structurally constrain long-term autonomy may carry higher cumulative cost than entering a structured uncertainty phase. In other words, the cost of compliance can exceed the cost of ambiguity. Once that equation flips, the leverage dynamic reverses. Because here's the reality rarely discussed in campaign speeches. The United States is not insulated from North American supply chain instability. American auto manufacturers rely on components that cross the Canadian border multiple times before final assembly. Agricultural exporters depend on seamless regulatory coordination. Energy infrastructure, particularly in border states, is interconnected at grid and pipeline levels. When uncertainty enters that ecosystem, investment hesitates. Investment hesitation is not ideological, it is mathematical. If you are a manufacturer considering a multi-billion-dollar plant expansion in Michigan, and you know that beginning in July 2026, the governing trade agreement could face annual renegotiation risk, you price that volatility into your projections. You delay, you hedge, you reconsider location. Multiply that across industries, and the macroeconomic effect compounds. This is the blind spot embedded in the original assumption of dominance. Size does not eliminate exposure. Integration amplifies it. And that brings us to the uncomfortable reality facing Washington right now. The administration must balance two competing imperatives. On one side, economic stability demanded by business leaders, donors, and workers in trade-dependent states. On the other, political optics demanding visible toughness and resistance to perceived concession. Backing down publicly risks narrative damage. Escalating materially risks economic fallout. That is not a comfortable equilibrium. But the pressure doesn't stop at economic modeling. It is now bleeding directly into domestic political dynamics, and that's where the squeeze becomes visible. Inside Washington, what began as a controlled trade posture is now evolving into a multi-front squeeze, and it's unfolding in real time. On one side are American manufacturers, agricultural exporters, energy producers, the very constituencies that form the backbone of trade-dependent states. On the other side are hardline political voices demanding escalation, even if escalation carries collateral damage. And in the middle sits a White House that cannot easily satisfy both. Business groups are not subtle when supply chain risk rises. Auto manufacturers with assembly plants in Michigan and Ohio understand exactly how integrated their production lines are with Canadian parts suppliers. Agricultural exporters in Iowa and the Dakotas rely on stable cross-border flows to keep margins predictable. Energy companies operating along the Northern Corridor depend on regulatory continuity. When the possibility of rolling annual trade reviews enters that ecosystem, boardrooms don't debate ideology, they debate risk exposure. Warnings have already grown sharper. Industry associations have begun modeling disruption scenarios tied to prolonged review uncertainty. The numbers are not small. Supply chain recalibration, tariff retaliation cycles, investment hesitation, all of it aggregates into billions in potential annual drag. And unlike abstract geopolitical disputes, this one hits directly at factories, freight routes, and commodity pricing. These are not distant political actors. These are employers, donors, and regional anchors in states that carry electoral weight. When they call Washington, they are not asking for rhetorical victories. They are asking for predictability. At the same time, a different pressure builds from within the political base. For hardline factions, Canada's posture is interpreted not as strategic calculation, but as defiance. From that perspective, The appropriate response is maximum leverage, including the possible use of Article 34.6, the unilateral withdrawal provision allowing 6 months' notice to exit the agreement entirely. That option exists. It was negotiated into the text, but invoking it would detonate far more than leverage. It would detonate certainty. The administration now faces a narrowing corridor: de-escalate and risk appearing weak, escalate and risk triggering precisely the economic instability business leaders fear, attempt to thread the needle, and both sides grow restless. Even within Republican ranks, subtle distancing has begun to surface. Senators from agriculture-heavy and manufacturing-heavy states understand that trade uncertainty is not an abstract debate. Farmers operate on tight margins tied to export access. Manufacturers operate on thin tolerances tied to integrated supply chains. Public comments emphasizing the need for stable North American trade relationships may sound measured, but they signal unease. And when unease becomes public, it is usually far more intense in private conversations. This is where the squeeze tightens, because the closer July 2026 approaches, the less room there is for ambiguity. Markets do not wait for political consensus. They price probabilities. And then there's another front, one that operates quietly but carries significant weight: the legal architecture of the agreement itself. The USMCA was not simply a political handshake. It contains structured dispute settlement mechanisms designed precisely to prevent unilateral interpretation of obligations. Chapter 10. Panels exist to adjudicate whether tariff actions and trade restrictions comply with the commitments undertaken in the agreement. Those panels are not symbolic. Their preliminary findings carry credibility in arbitration environments and in investor calculations. Recent challenges filed in U.S. federal court and through dispute panels argue that certain tariff actions taken under domestic trade statutes conflict with obligations embedded in the USMCA framework. The language emerging from preliminary assessments has been measured but pointed, phrasing that suggests inconsistency with agreed terms. In trade law, that is not casual wording. It signals exposure. Here's why that matters. If dispute panels determine that actions violate the agreement's own mechanisms, the United States does not simply face diplomatic irritation. It faces structured countermeasures and reputational cost. The agreement was negotiated with enforcement architecture specifically to avoid precisely this kind of unilateral drift. That architecture is now functioning as designed. When conservative trade attorneys and market-oriented legal scholars begin describing a government's position as difficult to defend under arbitration standards, that language carries weight beyond partisan lines. It tells investors that litigation risk is not hypothetical. It is procedural. Legal exposure compounds political pressure. It narrows maneuvering space. And the symbolism is powerful. The United States insisted on strong enforcement mechanisms to ensure compliance. Those mechanisms are now constraining American action in ways that cannot simply be waved away. The institutional guardrails are holding. All of this feeds back into market psychology. Investors assess not just economic data, but governance stability. If the world's largest economy appears willing to test the durability of agreements it negotiated, counterparties adjust. Currency stability in Canada amid tariff pressure is not accidental. It reflects confidence that Ottawa's strategy is anchored in institutional predictability. Equity volatility in the U.S. reflects uncertainty about policy trajectory. This is the deeper shift underway. The confrontation is no longer just about tariff rates or negotiating posture. It is about credibility, legal credibility, economic credibility, and political credibility. And credibility, once questioned, carries a premium cost. The next layer of this story moves from institutional tension to household impact. Because while policymakers argue over leverage and arbitration panels draft findings, ordinary Americans are exposed to the downstream effects: retirement portfolios, grocery prices, manufacturing employment, pension stability. These are not abstract variables. They are the real-world endpoints of trade policy volatility. And as we approach the midterm cycle, those endpoints are moving closer to center stage. At some point, every geopolitical confrontation stops being theoretical and starts showing up in numbers people actually feel. That transition is beginning. When markets sense sustained trade instability, they don't wait for final outcomes. They adjust in anticipation. That adjustment filters outward into equities, into bond spreads, into commodity pricing, and eventually into consumer costs. If you hold a retirement account heavily weighted toward manufacturing, industrials, or large cap companies deeply integrated into North American supply chains, volatility tied to trade uncertainty isn't an abstract headline. It becomes visible in quarterly statements. We've already seen early signals. Equity sectors exposed to cross-border manufacturing have shown increased sensitivity to trade rhetoric. Currency markets have displayed a notable divergence, the Canadian dollar holding firmer than many analysts predicted, while U.S. indices show episodic swings around trade-related announcements. That divergence reflects shifting assumptions about which side bears greater marginal risk. And then there's consumer impact. Auto prices are directly influenced by parts that cross the US-Canada border multiple times before final assembly. If supply chains slow or tariffs layer unpredictably, those costs accumulate. Grocery prices can be affected by agricultural trade friction, especially in regions dependent on cross-border distribution. Energy pricing in certain states reflects pipeline integration that does not easily unwind. None of this happens overnight, but uncertainty itself acts as a tax. Companies hedge. Hedging has a cost. Investment pauses slow expansion. Slower expansion affects employment and wage growth. The ripple effects compound. Politically, this comes at a sensitive moment. Economic management has historically been a central strength for administrations seeking re-election momentum going into midterms. Yet, polling already suggests growing skepticism around the handling of trade tensions. When a majority of voters begin expressing concern that a particular trade strategy may be hurting the domestic economy, that perception matters, even before hard data fully reflects the shift. For opposition campaigns, the messaging writes itself: stability versus chaos, predictability versus brinkmanship. Manufacturing states like Michigan, Ohio, Pennsylvania, and Wisconsin are not abstract electoral maps. They are communities where trade policy directly affects plant shifts, supplier contracts, and pension fund exposure. Voters there understand supply chain disruption not as ideology, but as lived experience. If July 2026 arrives without a clean extension of the agreement, if instead the review enters a tense negotiation cycle or slips into annual renewal mode, the political narrative will crystallize quickly. Every delayed factory expansion becomes a talking point. Every retaliatory tariff cycle becomes a campaign ad. Every uptick in consumer prices becomes evidence in a larger argument about governance style. And yet the implications stretch far beyond domestic politics. The USMCA was intended as a generational framework, a signal that North American economic integration would remain stable and durable for decades. Trade agreements function not only as economic tools, but as credibility anchors. When businesses commit billions to cross-border infrastructure, they do so on the assumption that the governing rules will not fluctuate unpredictably. If that assumption erodes, global partners notice. Japan watches how the United States handles trade commitments. Germany watches. South Korea, Australia, and others calibrate their long-term planning based on expectations of American reliability. When Washington appears willing to use structural review mechanisms as pressure instruments, counterparts begin designing contingency pathways. They diversify, they hedge, they seek redundancy. Canada's recent emphasis on diversifying international partnerships is not simply economic opportunism. It is strategic insulation. When officials speak about expanding Pacific corridors or deepening European ties, they are signaling an awareness that reliance carries risk. And once a country invests in alternative networks, once supply chains, shipping routes, and investment channels begin shifting, reversing that diversification becomes expensive. This is the subtle but profound consequence of the current standoff. Even if the USMCA ultimately receives an extension, the period of uncertainty itself may accelerate structural shifts already underway. Countries rarely unbuild contingency plans once constructed. For over 2 centuries, the United States has functioned as an anchor within the global trading system. Anchors provide stability precisely because they are heavy and predictable. But if partners begin constructing emergency exits, the anchor's gravitational pull weakens. Markets price that possibility long before it becomes visible in diplomatic communiques. And now we arrive at the most time-sensitive piece of this puzzle, the countdown to July 2026, when theory meets decision. July 2026 is not an abstract date on a policy calendar. It is a trigger point embedded in a binding agreement. And as of right now, there is no clear, publicly articulated framework guaranteeing a smooth extension. That absence of clarity is the story. The formal joint review required under Article 34.7 is approaching fast. For the agreement to lock in another 16 years of stability, all 3 countries must affirmatively agree. That means active consent, not passive continuation. If even one party withholds that consent, the agreement shifts into rolling annual reviews, injecting recurring uncertainty into every sector tied to cross-border commerce. And here's what makes this moment so precarious. Uncertainty compounds over time. Each week that passes without visible alignment hardens negotiating positions. Canadian diversification efforts become more entrenched. American business anxiety becomes louder. Political narratives become sharper. Manufacturers in trade-dependent states are already modeling contingency plans. Agricultural exporters are assessing exposure. Investment committees are evaluating whether capital allocation should tilt toward regions with more predictable trade frameworks. None of those decisions are ideological. They are defensive. Meanwhile, inside Washington, electoral math looms in the background. Midterm cycles amplify economic narratives. If the USMCA review descends into brinkmanship, if headlines fill with retaliatory measures, tariff threats, or stalled negotiations, incumbents in manufacturing-heavy districts will face difficult questions. Stability is politically powerful. Volatility is politically expensive. The irony at the heart of this entire confrontation is difficult to ignore. The sunset clause was originally inserted to ensure leverage, to guarantee that no partner could grow complacent. It was intended as a periodic reminder that access required alignment. But leverage only functions cleanly when one side fears disruption more than the other. Once that fear becomes mutual, leverage transforms into shared vulnerability. Mark Carney appears to understand that deeply. His approach has not been loud. It has not relied on theatrical confrontation. Instead, it has emphasized preparation, diversification, and institutional process. He is not required to win the review outright. He only needs to demonstrate credible willingness to tolerate uncertainty if demands exceed acceptable limits. That credible willingness changes the equation. Donald Trump's political identity has long centered on the assertion that no negotiation leaves him outmaneuvered. The challenge now is that this negotiation is governed not solely by rhetoric or personal persuasion, but by legal text signed into force years ago. The mechanisms operate whether or not they are politically convenient. They do not respond to messaging. They respond to procedure. And procedure is approaching. This moment is about more than tariffs or tactical positioning. It is about how modern economies function when deeply integrated systems collide with hard-edged political strategy. It is about whether agreements designed to stabilize commerce can withstand being used as pressure devices. And it is about how markets interpret credibility when institutional guardrails meet political will. If a clean extension emerges in July, markets will exhale. Investment hesitation will ease. The narrative will shift toward resolution. But if the review fractures, if it slides into annual renewal cycles or escalates into unilateral withdrawal threats, the consequences will not be contained to diplomatic press releases. They will ripple through factories, farms, pension funds, and portfolios. Every week without clarity increases the probability that structural diversification becomes permanent rather than precautionary. Once companies build alternative supply chains, they rarely abandon them completely. Once governments deepen new trade corridors, they seldom dismantle them. That is the long-term cost of uncertainty. It reshapes behavior. Right now, in Ottawa, policymakers are preparing for the July review with calm deliberation. In Washington, pressure builds from multiple directions: business, political base, legal scrutiny, electoral timing. And in financial centers around the world, analysts are watching the same clause, the same calendar, and recalibrating risk. The document at the center of this confrontation bears signatures from leaders who believed it secured lasting advantage. Instead, it has become a mirror reflecting the limits of unilateral leverage in an interdependent economy. The stakes could not be clearer, the timeline could not be shorter, and the outcome will shape not just North American trade, but the perception of American reliability in a world that increasingly values predictability. This story is still unfolding. July 2026 is coming fast. Markets are already reacting, and the balance between leverage and stability has never been more fragile.